Hello from Core Wealth. It's me, Kevin French. We're going to be having a look at the month of July. In Cape Town, it's been a very wet period, but markets have actually been quite good during the month, and we'll have a look at that now. A couple of points on the international news. The first one is what we saw in global equity markets, where there was a rotation from the previous Magnificent Seven big stocks, technology-driven stocks that had driven the market for most of the last over a year now, and especially the first half of this year, into a much broader base of shares. And in fact, those Magnificent Seven were negative for the first time in July, while the rest of the market was quite positive. We'll talk about that in more detail later on. The other thing that we've seen in the US is that inflation is now coming under control. And this has, the market now believes that there'll be 3 interest rate cuts before the end of this year of 0.25% each. And that has also been positive for the global bond market, which has improved quite nicely. Then lastly is, on the other side of the world, is what is happening in China. And in China, we've seen concerns now being raised on their stock market. Their market's still soft. The economy's not growing as fast as they wanted it to, and some concerns around if Donald Trump gets re-elected and Joe Biden has pulled out of the race now, and Kamala Harris has been is now the presidential candidate for the Democrats. If Trump gets in, the relationship under his previous term as president was quite acrimonious with China, and that could further affect the Chinese economy. Our stock market in South Africa was up strongly in the month, over 4%. A lot of that on the back of just optimism around what the Government of National Unity is already getting right. Some of those ministers in their positions now for about 3 weeks, and just seeing some positive things coming out. That bodes well for economic growth in South Africa into the future. In addition to that, the companies that did well were local facing companies like our banks and retailers, up over 6% for the month. And then on the back of what I mentioned earlier around global interest rate expectations, we saw our bond market continue to improve, and the one government bond went below 11% for the first time since beginning of 2023, which again was positive for our bond market. So let's have a look at how the underlying markets did. And we can see here for the month of July, lots of green there, meaning that markets were all positive. Biggest one was global property, but that was playing some catch up after some really weak returns over the last 3 years. Japan also did very well. The UK equity market's up quite strongly for the month. And emerging markets are a little bit soft, but still positive. So generally a good month in absolute terms, with markets picking up quite nicely. The long-term winners have definitely been the developed world equities, giving some good double-digit returns over the last 5 years and 15 years. But we think at the moment that there is room to see some of the emerging markets picking up quite nicely. And we saw part of that with for example, South Africa and India during this month. For our South African investors, again, a good month in the sense that our equity market was up some 4% almost, and the listed property market slightly better than that, and the bond market was also up 4%. So not really anywhere to complain about if you think of those different asset classes. Cash not the place to have been, as we see markets proving cash low risk and therefore low return. The rand slightly weaker against the dollar for the month, but stronger against the pound and the euro. And interestingly, if you look over the last both 1 year and 3 years, the best place to have been was actually listed property. Over 3 years, getting close to 11% on South African equities, which is a nice real return. We do think that if we look at valuations and some of the tailwinds we spoke about from the changing political environment in South Africa, that we could see the South African equity markets do quite well into the future. Here is a look at our UK global model, so denominated in sterling but invested around the world, and we can see they're the youngest in our range, will be 3 years old at the end of September, but giving you a return ahead of competitors since inception, all of those blocks green. Some slight underperformance over 1 and 2 years for the more aggressive strategies in the range, but our growth strategy over the last year is still giving you 11% per year in sterling. So a really healthy result there, and the longer term numbers looking very good. So looking at our global strategies, but those denominated in US dollars, we can see here that versus the class average, lots of all green everywhere. So we've outperformed the class average by all the strategies over all the periods shown here, and heading towards an 8-year track record on these funds. So very happy to see that. What's really nice is just the absolute level of return over the last year. The growth strategy giving you also 11% in US dollars. And if we look at that since inception, which includes the COVID crisis, includes the massive pullback we saw in global markets in 2022, and even with that, the growth strategy has given you over 7% return since inception in US dollars. So here's looking at the different models we run for the South African based clients that we have, and again, a lot of green on here, showing some good performance relative to their peer groups, both over the shorter term and more importantly over the longer term. What I would probably just like to highlight is the significant growth in wealth that we've seen for our clients. If we look at the more longer term and aggressive strategies, things like Core Wealth Balanced, the retirement growth where our clients who are saving towards retirement are invested, and you look at the 5-year number, retirement growth up 12%, our Core Wealth Flexible strategy up 13.3%. That's in periods where you've had inflation of somewhere around 5%, maybe even slightly lower. So you've had really strong real returns, and that means that as an investor, you're getting wealthier when you outperform inflation by those type of margins. And then again, since inception, some numbers now starting to get back into the double-digit range, and again, well ahead of inflation and ahead of the peer groups, which is particularly pleasing. So let's talk about the big story that we mentioned at the beginning of this video of the mega cap rotation. This slide just shows the Magnificent Seven, the big drivers of our equity markets globally, and you can see the different companies. You can go through their names at the top, names like Alphabet, Amazon, Apple, and how they've performed, and you see a particular surge from the sort of end of 2022 when ChatGPT and the benefits of large language models started to become evident in markets around the world. So what we know is that those stocks drove stock markets really strongly. The S&P 500 in America, this slide just shows you how they influenced it. In the first half of the year, the Magnificent Seven made up more than half of the return, the orange portion in this graph, of the whole index, just 7 stocks out of 500. But in July, since the start of the second half, we've seen that they've actually been a drag on performance, and the rest of the market really started picking up. The rest of the market up some 3.5%, while the Magnificent Seven were negative. One of the reasons for this is that those Magnificent Seven, a number of them anyway, do not have a lot of debt. They are very cash flush and do not worry when interest rates change, because they are not sitting on a whole lot of debt that they have to pay back. The rest of the market, however, when interest rates start to come down, and this graph just shows you how inflation is coming under control, and when that's under control, interest rates can come down, and the inserted graph in the middle just shows you the expectation for an increase in the number of interest rate reductions over the rest of this year. The other thing that we saw in July was further announcements of results by a number of companies in the S&P 500, and this graph just shows you what happened. A number of those Magnificent Seven actually disappointed in their earnings. They weren't as good as they expected. Something like Tesla reported their lowest margin in the last 5 years, and what you can see here, the blue line, sort of at the middle of, just after the middle of July, really comes off quite a bit. It bounced a little bit towards the end of the month, but came down quite dramatically. While the green line, which is the rest of the S&P 500, some of those smaller companies that I mentioned earlier, they really sprung to life and were up considerably during the month. The result being that The Russell 2000, the broader market in the US and some of the smaller caps, was up over 10% in July, while the S&P as a whole was only up some 1% for the month. So really a clear indication of that rotation, which we think is merited given the valuations that some of those smaller companies hold, and we could expect to see further movements in this regard going forward. Thanks for your time in watching this. We hope it's been helpful. If you have any questions, by all means get hold of us. We are looking forward to the rest of the year, and maybe some warmer and a little bit drier weather in the Western Cape at least, but hoping to see further unlock of some of the potential that we see in many of the portfolios and seeing that filter through into good returns for our clients.